Hey guys, John Polemy here, Actionable Intelligence. This is episode 3 of the Actionable Intelligence Alert interview series. And today we have a guest all the way from Bali. Fergus Cullen goes by Trader Ferg on Twitter, and very intrigued with a lot of his tweets that he makes, a lot of quotes that he makes of famous investors, and just his overall way of thinking about the markets. And so we wanted to have Ferg on and just explore what's going on in the markets, his views, and what he's doing. So welcome aboard, Trader Ferg. How are you?
Good, thank you, John. Thank you very much for having me. Always loved watching your YouTube videos. It's an honor.
Yeah, appreciate it. Like I said, we're trying to be a little bit more, shall we say, eclectic or a little bit more out of the mainstream, but so far so good. Um, Before we get going here too far, just wanted to see if you want to go ahead and introduce yourself a little bit, talk about a little bit about your background and what you got going. My impression is, and we've talked before briefly, but you kind of are a full-time trader, if you will, speculator, however you define, I'll let you define yourself. But I'm kind of intrigued because you're the kind of guy that has to go out and kind of kill what he eats. So that's kind of interesting. So I'll just let you tell your take a few minutes and introduce yourself.
Yeah, no, certainly. Thanks. So, yeah, I'm a Kiwi. I'm from New Zealand and grew up on a farm there. So never really thought I'd get into this way of life, but ended up moving to Australia to chase a few dollars, and ended up in asset management there, and enjoyed it for ended up working there most of my 30s. And that was also when I was lucky enough to run into Brad McFadden at a conference I went to there. And so he ended up mentoring me. And for those of you that don't know Brad, he is he's managed like high net worth individuals' money for most of his career, and he's now involved with Chris from Capitalist Exploits. He's got his own fund, and yeah, I've kind of been working with him. So we went from sort of a mentor arrangement to I've been working with him for the last few years. And yeah, so after roughly 3 years of working with him, I got my trading to a level that I decided to quit my career, and that was just before I turned 30, and went to Europe and managed money for some people for a little while, and didn't really have a great experience with that. I don't really like the aspect of managing people's sort of psychology or almost their shrink as much as managing the money. So after 2 years of doing that, I then moved to Bali and dropped my cost of living, and have been enjoying life here for just over 2 years now. Um, Live next to the beach in Canggu in Bali, and yeah, just absolutely loving it. So that's just a quick sort of recap. Yeah, so no, I just trade, and that's literally how I've made my income for 4 years now.
So that's pretty interesting. I guess one of the things that really, when I picked up on your Twitter feed, and I think you kind of share the same opinion I do, I think that I've really been trying to encourage other people, and I've done it for a while, is to really curate a really pretty good Twitter feed of, not cat videos or little kid on tricycle videos, but actually there's a lot of smart people, a lot of
Yeah,
engaged people switched on Twitter that you can really, I mean, people have like 1,000 or 2,000 followers, and they're some of the smartest people, so you can, engage with them. But I think one of the things that intrigued me about you and what you're, and I kind of want to use this as a lead into the conversation. You have on your pinned tweet, it says, if you're young and aren't married or have kids, this is the time to educate yourself and position yourself to get lucky over the long term. Capturing one big trend and riding it for all it's worth can be the difference between life in a cubicle and achieving financial freedom. Now, I know a lot of people, when they see that, they don't think that that's actually possible, or they think that's hyperbole. But that was that's dated February 10th, obviously before what's happened in the world has happened, where we basically shut down the world economy. But kind of what were you kind of, when you say that, how does that kind of tie into your way of thinking and what you're trying to communicate there? Because you actually below that put a historical adjusted inflation adjusted uranium price going back to 1968, which captured the last two big uranium bull markets. So I think that you were probably referring to the possibility of another uranium bull market, but I'll let you fill in that.
Yes, the sort of idea behind that tweet, I guess, was just generally there's fewer ways to become really wealthy these days when sort of what the standard ways of having a job or investing in a house. And so I think what we've got sort of approaching now is what are generally terrible businesses if you're talking about shipping or uranium in particular with that tweet, and they make all their money in a very short period. So if you kind of understand history, which was what that chart was showing, that you have sort of a cycle play out every decade or two, and you position yourself for it, then it's one opportunity when you can really set yourself up for the rest of your life if you do your research, understand the risk reward of certain companies, and position yourself well.
So what we're really talking about here is kind of like seeking out, asymmetry in particular industries. This is one of the things that I'm really interested in too, is really looking out for these. This is really, I want to, fire some questions at you.
Yep.
Like uranium, let's use that as an example, because we've had some interesting news in the recent weeks about the shutdowns at Cigar Lake with Cameco and Kazatomprom in Kazakhstan now shut their mines down, or seems to reduce their activity, shall we say. I don't want to say shut mines down, but it seems to be like we have even further supply destruction. And we just have this narrative that's been created around uranium supply and demand and the asymmetry behind it. But I mean, how do you look at that as far as, I mean, there's a couple things that go into that, right? It's like identifying the opportunity, looking at a potential for that asymmetry, the historical narrative that you've pointed out, and then like kind of explain like, okay, you get involved in these things, and the difficult part seems to be for most people is, first of all, creating understanding the thesis, but then the main thing that seems to be is that patience. And it's almost, to my mind, it seems to be almost like you got to have like a certain gene or something that allows you to do that. But I mean, how do you? I'm throwing a lot at you right there, but just using it as uranium as an experience, how do you go about that?
Yeah, well, I think as you say, you've got to have a certain gene. I always joke about the marshmallow test. Like there's the people in the world that are that kid that instantly ate the marshmallow, or there's the other kids that could wait around for 30 minutes for the second marshmallow to come out. And I don't think you can teach that. I think you're either patient by nature or you're not. And that's what really drew me to the uranium trade. Is kind of every day that goes past, the thesis gets a little bit stronger because you're generally seeing more supply destruction, and more so in the last few weeks than it's really just sort of really kicked off when you consider how much has come off now with COVID-19. But I've always loved that idea that you can see a thesis slowly playing out, whereas just to draw an example, you have the likes of the Kyle Bass and the Mark Harts, where they were trying to pick kind of situations like the Chinese devaluation, where there was no reason that ever had to play out. And not only that, but they also were using instruments that they were going to be constantly taking pain, like they were buying sort of call options for the devaluation, or put options, whichever way they're playing it, and they were having to watch those expire on a yearly basis, and then have to come up with the cash again. So not only was it not a sort of a win, not a question, it was also a painful trade to stay on. which is why I like uranium so much, is that every month that goes by, I've got, like, I trade income as well. If I can sneak another $1,000 across into my uranium account, like, I'm almost welcoming this dragging on a little bit longer so I can get a bit more into the market and know that the thesis is just getting stronger and stronger. You can see those contracts rolling off with the utilities. Like, we roughly know that by next year, you're going to have sort of 2/3 of the US utilities uncovered. So you're somewhere around the sort of 30, 35 reactors. And then by the end of 2022, then you're starting to get up around the 50% of US utilities uncovered. And that's before you take into consideration the fact that they're going to take 18 to 24 months to put the fuel through the cycle. So that's really going to be a situation that they can't just sit on their hands, and especially not with what's going on now. So that with, along with sort of the asymmetry of the sector, with this, just the sheer supply destruction, is what I just find fascinating.
A couple questions. You know, you just talked about some other traders and their experience, and we look at this uranium trade, or I do at least, as, I mean, I hate to use other people's cliches or whatever, but it's like, you know, a guy like Rick Rule says, I like to use this because it's just so obvious. It's, you know, either the price of uranium goes up or the lights go out. I mean, it's actually, if you think about it, it's actually true, because people don't realize, you know, the amount of electricity that's actually produced from nuclear reactors. But part of that, you know, I think, is the psychology and the patience. You know, for myself, I've been involved in this, you know, probably for the last 4 years now. I was early to it. I'm always early to these things. But, you know, I mean, you think you're buying at a, you know, I mean, I guess as a generalist like I am, do I do research? Yes. Am I doing like cash flow or in the ground calculations of how much uranium and what's the really mining environment in Namibia versus the Athabasca? I mean, I'm not doing that level of fundamentals. I'm just looking at it as a big picture, as a generalist. Obviously, I am looking at some of the companies and looking at their cash and stuff like that, and a general 10,000 foot view. But how deep do you go into this? And then also, once you get in your positions, and then, I mean, we've seen some of these things, you get into it, you think you've bought it cheap, and then you get another 50% drawdown, and it's like, you know, it's almost stomach churning. And you think to yourself, you know, what am I doing here? I'm going to blow my brains out. You know, because it could go, something that goes down 90%, as one of my friends said, can still go down another 90%. So, couple things there. First of all, how do you look at it? Do you really deep dive it like a Justin Hune does, a Uranium Insider? I mean, his whole life revolves around it. Mike Alkin, these guys, they know, they got spreadsheets out, the yin yang. Or do you kind of get the overall thesis and then position yourself, and then how do you deal with the drawdowns, even when you think something's cheap and it has potential, but you still see additional drawdown?
Yes, a bit of both, really. So I do deep dive some of the companies I'm building bigger positions in. I want to know that I'm not going to get diluted to hell and have too much cash. So we just got 2 puppies that we picked up because everyone's been dumping them. We're leaving Bali, so we adopted 2. They've been a bit noisy. Sorry, but yeah, back to the question. Just a bit of both, really. So I do like to deep dive the company and see what is the cash they have on hand, what do I think they can achieve to sort of, if I'm going to overweight them, are they de-risked mainly? I'm not trying to be smart with working out what cash flows they'll have in the future. I think we can kind of understand what they'll achieve if it's any sort of resemblance of what happened last time around. So I'm always focusing on how do I get the biggest margin of safety with the companies, is the main way. And then I do reach out to a lot of the experts. Like, Justin's just a wealth of knowledge on Twitter, so often ask him questions. And obviously I've got Brad that I talk to a few times a week. So I'm very lucky with the people I'm surrounded in, as well, to sort of bounce the ideas and fought up with them.
And how do you, I mean, what we've seen, even though, we have this thesis and, we understand the supply thesis and the demand thesis, but how do you, I mean, I, I don't know if the question is good or not, but, you think you've got something, well, term I use, you got it dicked, and then you get, hit with another 50% drawdown. Does it ever make you question, or how do you, at what point, because this kind of segues into, let's juxtapose this question like the offshore drilling industry, where it's not investable right now, and that just happened to us in the last couple months, or last few weeks actually, since coronavirus really took off. But I mean, how do you know when a thesis is blown up, or you just got to say, I just can't play this hand. It's deuce jack off suit, I got to fold this hand. I mean, how do you go about determining that, throwing in the towel?
Yeah, so I think, well, for starters, you got to be careful to not equate just volatility with risk or being wrong. Like, for instance, one of my positions, I've happily kept averaging into it with uranium, and the lower it's gone, the more I've bought. Whereas on the other side of that, with offshore drilling, pretty much decided, like I think I wrote a tweet on it saying that accepting I'm wrong. Like, I had 1% allocation to Valaris, 1% to bore drilling, and 1% to Transocean, and those now have such a high opportunity cost and also risk of just being straight chapter 11s that they can't overcome that opportunity cost. I'm down sort of between 85 and 90% on, or even more, on Valaris. So there's no way those trades will come good. So that's when you have to clear you're wrong. But that also doesn't mean the thesis is wrong. It's just the way it's chosen to express a view. Like, the companies didn't have the balance sheet to probably make this through to the other side. And it's just too early that the opportunity cost is too high to overcome. It's not much use if you've got to 10x your trade just to get back to break even. So that's in a scenario where you say you're wrong, but then understand when you're chasing the sort of 10 baggers, you're going to have a few of these in the portfolio, and that's the idea, that the other ones will make up for a handful of these in your portfolio. And I think the other one is to also understand that hopefully all these trades don't play out concurrently, and we're going to have an opportunity to rebalance from one sector into another that still hasn't got the love, and capture some more prices. Like, I really like the idea that the offshore is going to be going through pain at the same time that the tankers are getting love, and so there could be a chance to buy some of these restructured companies, or even emerging with new equity holders, and you get them with a very clean, or not clean, but far better balance sheet, and at a time when shippers are starting to look somewhat sort of overbought.
Oh yeah, I mean, that's exactly right. I kind of try to use, well, I don't all the time, but I use a lot of poker analogies. Before they outlawed it, I played quite a bit of online poker, and I was just able to clean up on the average player just from having the patience and understanding the setups. And most of the time I would have to fold, 25, 30 hands till I got a playable hand. I'm talking about Texas Hold'em now, and be in the right position. And that's, grinding it out on your leather ass is not fun, but if you're trying to make money, that's really what you need to do. And you're not going, and you can still, like I use the offshore situation as a perfect example. I think the thesis was correct 2 or 3 months ago. The lack of investment over time, the necessity of an extractive industry having to do a constant amount of investment, the depletion plus increased demand was leading to a slow. I mean, we had one of the worst oil service depressions in the history of the industry, and we were slowly climbing out of it. And then we got double whammy, black swan of COVID, demand destruction, then the ridiculous Saudi situations. So to your point, you just have to fold that hand. I mean, it's like if you get two aces dealt to you in Texas Hold'em, that doesn't guarantee you're going to win every hand. But if you play that hand correctly 1,000 times, you'll make money. I think that's how I kind of look at it. Just like you kind of explained, it's like if you know the historical narratives of these cyclical industries, if you play the hands correctly, then I think you're exactly right. The winners will more than make up for the losers that you have. But I think some of the questions, and a lot of times I get questioned by people that from on the videos I make or even in my newsletter is, well, how come you didn't recognize this earlier? How can you let it collapse by 80%? And it's like, okay, I made a video about 6 months ago where I said if I had, the money, just the scrap value of the rigs that Ensco had, plus the branding and everything else, I mean, you were getting a big deal, and now the company will probably end up in receivership. They just don't have the balance sheet. So, I mean, that things change, so you have to adapt yourself. Like Kane said, when my information changes, I change my view. What do you do, sir? So I think, that's the point. Is that how you kind of look at it? I mean, if you expect to, have a win rate on your trades of, even 40% or less than 50%, you can still make a good living at this if you catch the asymmetry.
Yeah, very, very much so. So I love using poker analogies because I think it translates very well to sort of speculating. Like what you're talking about there is like there's a very bad tendency across Twitter, especially is they call it in poker resulting. So it's just judging the quality of decision with its outcome, which will get you killed in the market over a long term because you just got to have a good process and stick to it. It's like my mentor always says, yeah, you just got to position yourself to be lucky and then stay at the table. So with resulting, it's just if you have bad outcomes, you sort of throw in your process and try something new. And if you have a good process, you will have a good outcome over time. You're just going to have to take some hits along the way. And that's exactly where we kind of find ourselves now. But I agree, it is difficult when you have those questions of like, yeah, when is it essentially a bear trap? When are you just going to keep having drawdowns until you go bankrupt versus when you should be aggressively averaging in? And I think a lot of it has just been seriously understanding the company's the cash and debt situation. Are they going to survive? Like I still have people on Twitter sort of debate me with the likes of Paladin, that's going to dilute and possibly go bankrupt, and they just haven't done the research to understand sort of the cash balance. It's obviously sold a mine, so it's got cash burn of another sort of 4 years, and very few people do that. Most people just want to sort of latch onto the idea of getting a huge return, which is what most uranium companies sell them. Whereas a lot of these companies are going to just dilute the hell out of people over the next sort of 6 to 12 months. So yeah, that's kind of
Yeah, I mean, that's I think maybe it was one of your tweets where you were mentioning the Annie Duke book you had read, or maybe it was somebody else, but
no, that was me. Yeah, I broke it all down in sort of a tweet storm.
Yeah, that's right.
I'm not a big fan of investment books in general. I think you could do your entire reading just with reading Howard Marks, a bit of Taleb and Annie Duke, and you'd be done. I reckon all the rest of it's generally a waste of time.
No, I think you're right about that. I mean, I'm a big Howard Marks fan. I think he actually, I think in one of his recent letters was talking about gambling and games and game theory. He mentioned Annie Duke's book also, but yeah, I mean, I think part of the problem is that a lot of people, and I've learned this just from the videos and stuff, and I mean, you're dealing with, people you don't know. I don't get too caught up. I used to get caught up into it. I don't really care anymore because I started realizing that when I read an article that 30% of the population was on psychotropic drugs, I kind of realized to myself, there's going to be all kinds of people you're going to run into online. But anyways, around the uranium, I mean, I think you mentioned it also the other day to a guy. There's a lot of guys out there. I try to help them, but it's like and this is why I do this interview series, because I want people to think for themselves. You know, Cuppy, I think, got caught up in this because he was really pumped. I don't want to say he was pumping it, but he was really hot on the trade, and he likes to joke around. And you know, he's a professional trader. This guy knows what he's doing. He built that hedge fund of his up from nothing. You know, and he's talking to people sometimes on these when he's getting interviewed, and he's not. Sometimes he had to dial it a little bit because I think he was getting inundated with, you know, emails and tweets or DMs or whatever, and people were asking like, well, how come the tankers aren't moving, and you know, your thesis is bust, and you got thesis creep and all this other stuff, and it's just like he kind of had to. I listened to a couple of interviews, and he kind of tweeted it out himself that, you know, hey guys, you got to do your own research. And I think that's what a lot of these guys are getting caught up. They want like affirmation, or they want somebody to tell them what to do. And I try to remind people, it's your money, it's your obligation. Yeah, you should try to seek out smart people and get ideas and have conversation with folks. But in the end, you know, if I get turned on to the tanker trade by somebody, and I think I heard about from Mintzmeyer or somebody like that. And I was, you know, I'm going to go do my own research. I'm going to understand this. I'm going to write it down and say, what's the real deal? I mean, my original view was IMO 2020, and then IMO 2030, what was going to happen, and then understanding the cyclicality of, you know, product tankers, and then, you know, what happened here with on sea storage. So I think there's a lot of as Jason Calacanis says in angel investing, there's a lot of tourists that come in and out of these things, and they're chasing the shiny object. And I don't really think they have a plan or they have a method that they follow. And I think that's what separates people that are successful. I mean, that's what kind of impressed me about your, you know, that tweet storm you did, and some of the other things you've said, and some other smart people I follow. You seem to have an actual plan, a method that you're following, as juxtaposed to what it seems like a lot of people are doing, which is just chasing the shiny object.
Yeah, it's that, like, you really have to understand what you're doing to have conviction, I guess. It's all fine to say have patience, but a lot of people that have patience still freak out when they have a heavy drawdown, because that's really when you got to know what you're doing, is when your account gets drawn down sort of 30, 40, even 50%, which has definitely happened with some of these uranium names. Like, you've got to understand like where the value lies to be able to handle that well. And if you're just a tourist that's jumping on this because Cuppy said so, then you're not going to have that conviction. You're going to freak out, and you're going to help put the bottom in the market. And also, something I always get kind of slightly annoyed with is like the Rick Rule references. Is the fact that people don't understand how he goes into these positions. So he's not alongside you as an equity owner. he's going in there and structuring deals. He's getting debt where he gets a nice fat interest rate, and it's convertible. So he makes out like a bandit. He gets warrants that often get backdated if he changes the financing terms. If the company does go under, then he goes from being a sort of a senior debt holder to being issued new equity. Like, he's not playing on the standard retail field, and yet everyone sort of says, I'm going to do the next Rick Rule trade. It's like, oh, you don't understand how much this guy's got, like, just so many more angles, and so much more experience than you, sort of coming in and just grabbing your few cents of stock and hoping it goes to $10.
Yeah, that's. I'm glad you brought that up, because I've said it on a couple of videos, and I got interviewed by a couple of people, and I brought that up, and it really got me a lot of incoming fire. And it's like, I consider myself kind of savvy, and I've actually been to one of those shows in Vancouver because I just wanted to experience for myself. And then I finally realized that there's this nexus in Vancouver, and certain extent into Toronto, when you're talking about resource investing. I mean, the Rick Rule nexus of how he's able to, you know, just like you said, these are people that are at the table getting the best deals. They usually are sitting down with people that are in capital constraints, so they can extract the best terms. And you're exactly right. The retail investor that's stumble bumming his way through this thing, and like you said, thinks he's going to throw $5,000 into something, it's going to be $1 million. And then that's not really how it is. I mean, it's shark infested waters up there, and I mean, it's like sitting down. It would be like the average weekend poker guy sitting down at the World Series of Poker final table. I mean, you just outclass. You have no chance. I mean, you can go there. Rick Rule will talk to you if you get up early enough. You can go down there and talk with him. He's a billionaire, but he's not going to tell you all these things. It's the, and then how does it work? They have all the newsletter writers, and they all get their, private placements. It's like when we were talking about Uranium Royalty Corporation. I did a video on it. I said, stay away from it. I mean, it's not for the average person. It's the properties aren't going anywhere. It's not something that you want to be involved with right now. And, all these people, it's the same Marin Katu. I don't want to name these people, but it's the same nexus of people. And they're, they sell their stock, they keep the warrant. I mean, it's just, it's a lot of, if you can't get involved in the private placement, you really can't play in that field. So, but I do think there's an opportunity, when we see something like uranium, that's probably, you could, well, theoretically, you couldn't really do it, but theoretically buy the whole thing lock, stock, and barrel for about $9 billion. And, this thing, once it gets going, if it goes back to what we saw in the last bull run, I mean, over $100 billion in market cap. So you're kind of just putting things into one of those new ETFs. You might be able to get a 5-bagger without even doing anything except sitting on your butt, not really knowing anything. But I guess that kind of segues into the next question is, here's a question that I get a lot from a lot of people, and I'm sure you think about this too.
Can I just mention one thing, John?
Yeah, go ahead.
Go ahead. Yeah, just when you're talking about, I think everyone should take the time to watch Jamie Keech's How You're Getting Screwed, because that really opens your eyes. That's brilliant. Quite a few people don't understand how founders issue themselves stock. So if you're buying in for 20 cents or something, there's a very good chance that they issued themselves a ton of stock at a cent. So that's what a lot of people don't understand, as well as a lot of the time your incentives are not aligned with the founders at all. And I've obviously had a few goes on that on Twitter, but I don't really want to anymore because it always stirs a hornet's nest. So pretty leave that. But yeah, I think everyone should take the time to watch that YouTube clip by Jamie Keech. I think it's how you're getting screwed, or something along that line.
Yeah. I mean, that's exactly right. I mean, I was just one of my friends. It was friends of my brother. He's a grain trader now, Nick Jones. He's Trader or Grain Jones on there, and he was taken after Dev pretty good last week on Vision. And I mean, he just didn't care anymore. I tried to tell him, I mean, got to be careful, because I've almost been sued by some these companies before, back in my previous blog iteration, probably about 10 years ago. There's a company called Admiral Bay Resources that I took after just because the founders were stealing from the shareholders, basically. And I mean, they actually sent me a letter. I had to retract some things just because I didn't want to. It's not worth it, and that was before Twitter. So yeah, you're right. There's really no hey, we know who these people are. I mean, certain companies to stay away from that, and I think that's part of it, right? People don't do the work. They won't get into the company's filings. You got to go on CDR. You got to get into the filings. I mean, there's certain people that are lifestyle executives. I'm not going to name them. We all kind of know who they are, and I don't want to get into that. But and I encourage people, they should go to one of those conferences in Vancouver, because you can get swept up in the carnival. I didn't, but a lot of people do, in the carnival atmosphere. And it's you're not getting the same terms as those guys are. But I mean, segueing into here's a question. I think, when do you think about selling? I mean, obviously we can't ever hit the bottom exactly, but then that's a big question I get from a lot of people too. It's like, okay, when do I sell? When do I think I need to sell, or what's a good way to do that? I mean, obviously changes for everybody, but what's your thought process, or how do you think about that?
I reckon that's going to be one of the tougher questions. I think I think we're lucky because we've all now recently had sort of a reality show play out in front of us with the cold crypto mania. So that is, I think it was quite an extreme example, but I'm I'm very interested how bull markets are going to play out with the age of sort of everyone having a smartphone that's connected 24/7 and having Robinhood apps that send you bloody notifications for everything. And it's just absolutely encouraging all the wrong sort of behavior, zero commission trading. So I think we're going to see an awful lot more of, guess what Soros sort of termed reflexivity. Like it's just going to drive booms that much quicker and that much more violently. So it's going to make it far harder to sort of time your exit. But with my sort of, I think I tweeted it at one point. It was just a simple sort of exit strategy was every time any of your friends or family that you've kind of mentioned it in passing sort of mentions that you should take 10% off the table. So it's sort of one thing that I think is always doesn't get talked about enough is you should always scale in and out of positions to sort of protect your sort of, what do you call it, your mental sort of mental health of your position, because it's far easier if you still have maybe 20% of the position riding it probably past the point at which you should have got out, rather than get completely out at a point, say that's it, and then watch it sort of triple on you again. So I think, yeah, just to generally take just generally scale out as your friends start mentioning to you. You see it on the news, you see it, you bring up Finviz and it's the top article for the day. That should always be another 10% off. So I think just generally scaling out consistently like that. And another rule I have is, once you have a decent win, then do not dive back into the market. Take at least sort of 3 to 6 months off, because your ego generally, I've done it before, had a big win and then just thought I was a genius, plowed back in and then dusted most of the money. So I think everyone generally has to learn it, but if you can internalize it without having to learn it, it's even better. Is try and even take the money out of your account, go and put it somewhere else, and let it sort of settle before you can view the market objectively again.
Yeah, I kind of I thought I was being smart during the Bitcoin mania. I mean, I got in the low hundreds. I mean, I was buying up until the 500 or 600. Then we had some mining going on, but I think I blew most of the position out. I started scaling out around 3,000, and I kind of kicked myself because I should have kept, like you said, a small position on, just because I underestimated how ridiculous. I mean, I kind of, pride myself a little bit. Maybe I shouldn't. That's the wrong word to use. I've read Charles Mackay's book on popular delusions probably 10 times. I try to think about these things, and I thought it was nuts at 3,500 when I was getting out, or $3,000 or whatever. And then the thing went to 18,000, and I was kicking myself. But you can't really do that. I mean, 5 or 6 times on your money on something that is very speculative. But you're exactly right. I mean, it's almost like the same type of toppy behavior. I was getting calls from people that have no business involved in these type of things, asking my opinion at 18,000, or 19,000 of that thing. And I was like, no, I know for sure that's the top. Then when I have those reverse barometers, I call them, those people that I know that are going to call me and ask you about it right at the top. But I think it's a good idea, scaling out, and then, because you're never going to catch the top, right? It's like, I had made a little bit of money on cannabis. I got into that early, but I didn't go all nuts in it. And I think another thing you can look at too, and I don't know how you think about it, is like during the cannabis thing, or during even the last uranium bull market. I mean, I think at the top there was 500 companies in Vancouver that were claiming themselves to be uranium companies. I just shift whatever to what's ever hot. Same thing, you were seeing companies just getting into some type of cannabis on their name, or who knows what. And then you look at them at the management teams, you're like, these people know nothing about this. It's I think that's a key to some of those, because they will I think somebody had a saying, when the ducks quack, they feed them in Vancouver. So anyhow.
Yes, you do have a few. So if you've studied history, there is a few few great indicators for getting out. One that's played out with uranium and Bitcoin was when they start listing new instruments like futures was picked the top of the last uranium, and also picked pretty much the top of Bitcoin as well. Was quite accurate. You've also got with uranium, if spot seriously overshoots term, then you know you're starting to get into some pretty dicey waters. Like that's yeah, but then obviously it's hard because that last sort of parabolic part of the spike can be where another sort of like 50% of the total returns are. So it's hard to be responsible and yet sort of capture the gains. I think you just got to look back on it and say that it's a good return, and you're not going to partake in the sort of craziness at the end. Or if you are, it's going to be with a very small proportion, maybe 10%, just to set a stop loss at some a sell order. I mean, at some crazy level, and just hope that it gets hit. And if it is, it's happy days. Otherwise, you've taken the bulk off. That's going to be more than enough to sort of set you up moving forward.
So let's delve a little bit more into uranium real quick. I mean, do you think? I mean, obviously we've had a lot of false starts. We've got past all the 232. I always thought that was nonsense. A lot of people were putting a lot of weight into that. But do you think? I mean, my thing on these cyclical businesses has always been that I want to, see that supply destruction. And, especially with uranium, there is no substitute. There is no other fuel. There is no other anything else that can be substituted for this uranium. So do you think in your mind, and when you look at this, and I'm not actually to be an expert on the supply and demand, fundamentals of this opaque market, but just your sense, do you have a sense that this might be the catalyst that finally wakes up the fuel buyers? Because I think they're kind of like herd animals too. They're like individual investors. They've had it so good for so long and at cheap prices that they really haven't felt the need to come and sign those longer term contracts. Is this going to be a catalyst possibly to wake people up? And I was talking to Justin about this when I interviewed him. I have a view, and I also talked to some other folks about this. I mean, maybe I'm just being a little optimistic. I'm looking at it as maybe even being, because of the lack of investment and the big, huge air pocket or gap in new mines that have come online or even have the ability to come online, is there a possibility that there's going to be a situation where it's going to be musical chairs and there's not going to be enough, somebody's going to get caught out? How are you looking at that fundamentally, or am I just being overly optimistic and that's kind of what I want to see?
I'm very optimistic on it. So yeah, I've been deep diving and reaching out to numerous. That's a great thing about Twitter. You can just reach out to all these people and get them to plug any holes in your thesis. So yeah, as you say, it was already a very bright picture before this happened, and now when you dig into some corners of the market that no one's really even talking about with uranium, like take Urano, like that almost never gets mentioned. But they're obviously it's the French company, which was formerly Areva, but no one really talks. They lost Cigar Lake, which was they had a stake in that, 30%. 30% stake in MacArthur. Sorry, they have a stake in Cigar, which they've now obviously. MacArthur River was care and maintenance. Cigar Lake's now offline with COVID. They've also lost their JV with the Kazakhs going offline. They've got Comac, which is it's only got 1 year to run and depleted. And if that goes off, there's a question hanging them over them whether it even makes sense to bring it back on. And that never gets mentioned. And yet these are guys that they were selling into spots over the last few years, and now they've actually just switched over to buying. So the spot market is just looking so thin right now and it's also intertwined as well, because you've got, like I did a thread on Cameco and how, so they were in quite a position before this even happened with how they were going to secure their so they got sort of roughly 30 million pounds they've got to deliver, and about 14 of that which they had through the JV and through Cigar. So now that's offline. So that's gone from what, 16 million that we're going to have to buy. So I think it was Brandon saying he thinks this Cigar offline is going to go on sort of 3 to 4 months. So that would be another 6 million. So you're now talking, so that 22 million pounds that Cigar's got to buy. And then you've got their joint venture with the Kazakhs, that they're not going to be getting pounds from them, or they're offline unless they supply it from inventory. So you've got all this strain that's going through the system, all this material that needs to be bought off the spot by Verano, by Cameco, and that, yeah, the sellers onto the spot just aren't there, with the Kazakhs now having this now Swiss trading arm. So they just essentially stockpiling it for higher prices, and really the only people selling into it are now BHP, which is only probably about the 8 million pounds it's selling onto it, which isn't going to get very far when we already know what Cameco's demands are, and a little bit from Uranium One. And I just think it's massively bullish when you consider, we can see all that demand is coming, that they have to fulfill these contracts, and yet there isn't going to be enough on spot over time. And at the same time, you've got US utilities cruising along and underbuying by sort of 20% roughly. So they're sort of short buying by 10 million pounds a year. So all you really need for them is to start to get a bit nervous, which surely they are around now, and go from underbuying by 10 million pounds to overbuying by, say if they just increase to 20 million pounds that they're overbuying, then that's going to have a super dramatic effect when we're already running such a deficit. So and that's before we even get to the fact of what COVID's going to have on the entire fuel cycle. Like, that doesn't seem to get mentioned either. Like, can't imagine the 24 months to get sort of yellow cake through the fuel cycle is going to be running very quickly at the moment around the world. Can imagine that's even been slowed. And so, yeah, I'm super constructive on it.
And I think, I mean, if you even want to go even further, one of the things Chris has been talking about for a while, and I've been thinking about this a lot, also is, I think he wrote an article, or somebody wrote an article, it was called Rise of the Strongman. And I think it was big on, this movement around the world towards more nationalism and these strong leaders, whether you want to talk about, well, people can argue what they think they're strong or not, but more looking inward, like Trump or Bolsonaro or Duterte or these different guys around the world, and the resource nationalism that's going to happen, the energy. People, I think, underestimate the civilizational value of each incremental BTU and what that really means and what it takes to deliver that, whether it's nuclear, natural gas, oil, whatever. And I think that, with this COVID thing, I mean, it's getting ramped up here in the US, at least, the rhetoric towards China. I mean, there's people in the Congress or in the Senate, Lindsey Graham, for example. I don't know if it's just rhetoric, but it's kind of feed into the narrative that Chris was talking about over a year ago, even, which was, we've got congressmen and senators here saying, well, we should just, default on the debt that China's holding. They need to pay for this. They need to be held accountable, that kind of stuff. And that's kind of, I think, being underestimated or not priced in at all across the spectrum when you talk about resources. And, I am actually doing some thinking, and maybe I'm thinking about doing some work on this and publishing it. But, this would be the perfect time for a distraction by Chinese. I heard Xi, for example, is under tremendous stress, even from some of the party elders and from some of the legacy people in the Politburo, that they're not real happy with the way things have been handled. And, this is just a time where, you have some expansionism or some distraction around Taiwan or something like that. I mean, this is really, a recipe for tempers flaring, and it's not really priced in, and nobody's really thinking about these things. But I think that was pretty prescient. I've seen other people that have written about that too, something similar. But I think that that's not being priced in either. I mean, think about a country like China or India. These people, China, for example. I mean, I'm not going to get into the renewable thing again. That's just a pain in the ass. But I mean, Chinese are going to build, and other folks want to build up their base-loaded nuclear fleet. I mean, where do you go to secure the supply so that if you're going to take on this $100 billion investment in building so many reactors, you're going to want to secure the fuel supply well in advance, just to load out and then several years in advance. And I talked with Malcolm Rawlinson about this, just about the whole fuel cycle and loading out in plants and stuff, and what the fuel buyers actually look at. And I don't think that's even being considered by most folks in this thesis.
100%. Yeah, people are stuck in first level thinking. I like the idea of like people. I'm just trying to think of it. I've got one good example of it. So when you talk about oil markets, everyone always sort of concentrates on developing countries. Like, are we going to offset our demand by renewables? Are we like EVs? But so the numbers, I think, was it's essentially a two-tiered market when you think about oil. You've got developing countries with roughly 1.3 billion people. We consume about 60% of the world's stuff, and that's what everyone concentrates on, is that number going up or down. But it's also pretty important to think about the developing countries, which is 6.5 billion, and they consume the other 40. And so if you put that into like the oil market, then you got developed world is consuming about 30 million barrels per person per year, whereas the developing world is about 3 million barrels per person per year. And if you just take population growth in the developing countries, then they're going to move from 3 barrels to 4 barrels per person over the next sort of 20 years. And that's huge. That's assuming like their standard of living stays the same. That's just population growth. That's assuming the developing world doesn't consume more oil. I think the developed world doesn't consume more oil. That renewables does sort of offset the increasing demand. It's just no one's thinking about this in the future. They're all just projecting the hell out of renewables and EVs, and shale will catch up with the rest. We're all so stuck in first level thinking, and also by denying developing world it was before this all happened. It's all quieted down now, but denying the developing world just energy is going to cause big issues moving forward, as you say, with China. If we try and force them not China so much, some of the more emerging countries, if we try and cut them off from coal, whatnot, whereas can't push them onto renewables because that isn't working. And so you do the full lap and say, oh, it's the way that all the developed countries got there was via burning fossil fuels. And now we're trying to say that developing countries can't use that. It's going to be a recipe for a lot more unrest around the world.
Oh, absolutely. I mean, I'm just fascinated with the whole oil market. And I've had two false starts now. I had the double clutch of the Trump administration when they did the double clutch with the Iran sanctions end of 2018. And then we got the black swan here. But I'm not giving up on it, because you're exactly right. I mean, I've built spreadsheets where I just do, okay, let's just take, Japan or South Korea's per capita consumption, extrapolate that across China's population, Indonesia, India. I mean, I think I ended up, if you want to, just do the exercise and go to European levels of development over the next 20 years, 30 years. I mean, you'd be looking at an daily oil consumption of 200 million barrels a day. That's simply not going to happen. The geology, kind of like Chris Martenson says at Peak Prosperity, you can't have infinite growth on a finite sphere here, this Earth. So yeah. I don't want to sound like a conspiracy peak oiler, but Matt Simmons, I read his book, Twilight in the Desert. It kind of went off the radar screen because we had this whole shale deal. and he died, of course. But I mean, you know, decline rates don't go away, and consumption does grow. Well, unless you have a depression like we're going to have now, self-inflicted, but we'll come out of this. But at some point, we get back up on plane, and you're exactly right. It's just a math problem, and I just don't see, Tesla selling, 5 million vehicles a year in India at $60,000. Where does all the cobalt come? I mean, these questions aren't answered by anybody. People that make a lot of money and are managing a lot of money and have a lot of play in the media make these ridiculous comments that can be easily, it's like, what the hell is this guy talking about? There's not enough cobalt to do this, even if we could do it. So, or whatever. And, it just fascinates me, because I think these opportunities, my wife came back from the store today, and I know I talk too much. That's part of the problem. I'm gonna let you in here in a second, but these ideas pop in my head. She came back. She was like stockpiling. I said, quit buying all this meat. And then she came from the store today. It's cleaned out. And I just read an article. Smithfield, which supplies is like 5 to 10% of the pork in the U.S., they had to shut their slaughterhouses down because everybody's got this COVID virus. And it's like, and you can't run a meatpacking plant unless there's a USDA inspector there, and they're all on lockdown. So no, I mean, a lot of things are happening, or like you said, that require second and even third level thinking, multi-dimensional chess, if you want to say it. And no one thinks these things through. And it's like some of these people are managing billions of dollars, and or have a lot of play in the media or thought as thought leaders, and they're actually clueless. You got some thoughts on that?
Yeah, well, they've all got career risk, so you can't afford to be wrong now for more than sort of a quarter or two. So even though they know what's the right thing to do over the longer term, they won't be around if they did that. So
That's right.
like it's like you've got I don't know, just like when you talk about no cobalt or no, like you've got the same scenario in most commodities as you have with oil. Like one barrel out of six being consumed has been replaced by new sources. So you've got similar to most things are now under their cost of extraction, or under their break even. And so anyone can see that the price is going to have to go up, but it's the fact that it's an unknown when that's going to happen. And they'll, if they try and guess it, and most people that had that logic have probably already had to close their funds because they've been cleaned out in the last 6 months. Like I thought buying offshore drillers last November, I think last October or November, was an absolute bargain. But if I'd been running a fund, I probably would have made that 5% of the fund, and just about clean that money out by now. And so it's seriously tough if you have to answer to any investors, which is what people don't often realize. Was I've posted it once or twice. It was even God would get fired as an active investor, and it's this idea that if you were God, you'd have the idea that you could perfectly see the top 5 performing stocks 5 years out. So you could know that these 5 stocks will outperform the entire market, and you'll have great returns. And so being God, you just buy them and sit back for 5 years. But if you're God as a fund manager, the volatility that you'd go through in that 5 years would generally get you fired by your investors. So hence the title, even God would get fired as an active investor. And that's the world we find ourselves as. People are generally unwilling to take volatility, when volatility is largely the price you pay for performance, I believe, anyway.
No, I agree with that. And I think not being under the gun and having to manage and answer to clients and running money, that gives us the advantage. The time arbitrage is in our favor as individual speculators. I want to throw another question at you. I mean, and I'm not a big macro guy. I mean, I do think about things, but it doesn't really enter so much into my thesis sometimes. I mean, some of these things are just big themes that, regardless of what happens with the overall economy, except in this, what I call, and you may disagree with me, but I'd like to hear your thoughts on it. This self-inflicted mass hysteria around this coronavirus, where we basically have a self-inflicted world depression now that's going to, we don't know how deep and how bad it's going to be. But what I find fascinating is the response that we're seeing by governments and central banks. And I want to get your perspective. I mean, I've been posting it. I mean, basically, the Fed's balance sheet here in the US at least, and similar with other balance sheets, I saw $1 trillion stimulus plan being proposed by the Japanese government. But here in the US, I mean, the Fed's balance sheet, which can be tracked weekly at the St. Louis Fed website, is like a rocket ship taking off. I mean, they've expanded the balance sheet by 50% in the last 4 weeks. So how does this kind of thing go into your thinking? I mean, you have to incorporate it as a speculator or somebody that's in the markets, because you're thinking to yourself, like, how is this going to affect what I'm doing? How are you thinking about all this stuff?
Yeah, so I was big, how to put it, how to summarize it. I guess, yeah, I was just reading Scott Grannis's blog before, so if no one's read that, I highly recommend it. And he stated his prediction was that in the fullness of time, we will come to realize that the shutdown of the US economy was the most expensive self-inflicted wound in the history of mankind. And I largely agree with that. I reckon this this has been blown so far out of proportion now with what it warranted with the virus, that we're going to look back on this and think the second order effect was absolutely magnitudes worse than what we actually achieved by trying to slow the virus. Because like one thing that always annoys me is that you should always kind of understand like the denominator when claiming sort of rates of infection or the mortality rate. And the only place that you ever really got that when you looked around the world was on some of the cruise ships. So you had the Princess cruises where there was 3,700 people, and everyone was tested. So that gives you a really good view of like of the actual stats, because you actually know the denominator. And so from those 3,700 people who tested, you had 712 infected, and then you had about 18% of them showed no symptoms, and 8 died. So it was about just over 1%, 1.1%. And what's really interesting about that is you've obviously got the asymptomatic people. So no countries are ever going to catch that number because no one's going to go in to get tested. And then on top of that, those cruise ships were, the average age was 60. So if you got younger populations, you'd see the fatality rate just drop off a cliff for anyone under sort of under 50, really. Got to sort of reach the conclusion that, yeah, this has just been one huge overreaction. And even more insidious is it's going to be essentially what allows the Trojan horse in of just sort of crazy fiscal policy, which is what I think you're referring to, is the fact that the Fed really is now, with these special purpose vehicles, they are going to be able to follow the Japanese model of just buying anything. Most people, it doesn't really see the light of day enough that just how much the BOJ, the Bank of Japan's done in Japan. Like, they now own 77% of the ETF market, and it's just crazy even say that. They own 50% of their JGB bond market, and now we've kind of the Fed's now sliding down this road. And if you studied history, you kind of understand that this all leads to inflation anyway you cut it. Like, it's people just don't understand the numbers. Like, if you're just looking at the Fed's repurchase agreements at 1 trillion a day, and then they've got unlimited QE at another 625 billion a week. If you forecast that forward a year, then it's about 2/3 of the treasuries that are going to be owned by the Fed. There's just such ridiculous numbers to even get your head around. So that's where that just makes me want to double down on commodities. It's once this cat's out of the bag, like it's kind of like saying, why didn't they stop at QE1? Like it's not the way things work. If they get their hands on the printing press, it's politicians are gonna have that thing running full revs for the next few years minimum, and we all know where that leads. So yeah, I think it's largely going to be the fuel behind the commodity boom, and it's going to be inflation's going to have to be what takes the sort of the printing press off them as such in the future.
Yeah, I mean, that's one of the things I made a video on. I try to use provocative titles, obviously, because I want to draw viewers to it. But I said, I put a picture of Trump in there. I said, meet your new Fed chairman, Donald J. Trump. And of course, I got these ankle biters. I mean, it shocks me that people don't really understand monetary theory or understand. I mean, I'm not saying I'm an expert on it either, but I mean, it's this idea that, you know, I mean, we're seeing it here in the U.S. I've seen, and this is anecdotal, of course, but I'm seeing just where I live in my community, some home invasions have started picking up. What I've seen, multiple reports in major cities now of these food banks getting inundated with just normal people that they show the lines being, you know, miles long. They fly over with a helicopter or whatever, and these people are in line, and we're 3 weeks into this thing. And I think the whole MMT, we talked about this before briefly when we were talking before offline, but this whole MMT thing I think is really going to gain legs now because Trump, I mean, people think that he's some kind of conservative. He really isn't. He's more of a, he kind of manages in 15-minute increments, I think. Whatever he thinks is the best thing for this, because he understands, you know, the American people's attention span, the average voter, and, you know, he's calling for like a $2 trillion infrastructure. And I'm not totally against that. I've kind of advocated that a long time ago. If you're going to have 0% interest rates and no one's actually going to pay the debt back anyways, and you're going to, you know, get rid of it through inflation over time anyways, inflation being increasing the money stock. But, you know, why not, you know? And but I didn't foresee a situation where, you know, we were going to be, you know, we're at 17 million already unemployed. I mean, I've heard reports we could get to 35% unemployment in this country. That took 3 or 4 years in the Depression. It could happen in 3 or 4 weeks. And I just can't see this in my own state here, Texas, for example. I mean, they're already going to start, the governor's going to open the state. He said, that's it. People got to start going back to work. They can't sit here and just, and to your point, it shocked me. Like you said, it's just, you know, math problem, denominator. And we have these reports, the so-called experts again. It's always the experts, isn't it, Fergus? It's like climate change and this, and the guy that was in the UK, everybody's based on his calculations of 500,000 deaths in the UK or whatever. Now he's down to like, you know, well, it may only be, you know, 5,000 or whatever. It's just shocking, the technocratic class and how everybody just bows down to it. And, you know, it's the same thing with like, you know, Stephanie Kelton and her MMT. She wasn't the originator of MMT, but I guess we're going to do it. I mean, I guess it's going to be the experiment. And like we talked about before, people make the mistake, I think, if we are going to have an inflationary environment, which I believe we will, severe inflation, gold isn't necessarily the best performer during that time. I mean, you and I talked about this before. I mean, if you can remind me, I think what was the best performing commodity or asset class during that time? It's either copper or oil. I can't remember, but we talked about that before.
Yeah, as an actual asset class, it's energy. So if you map, if you map gold against its gains for every 1% rise in CPI in the US, it sort of was roughly 5%, whereas energy was nearly 30. So you're getting, if you're preparing for inflation, you want to play it by energy, you want to play it by oil, gas, because you're going to get 5, nearly 6 times the payoff of being in gold. This is before you obviously leverage it or whatnot. So yeah, people often miss that, as gold's just there to essentially protect your purchasing power. It's not as leveraged to inflation.
Yeah, exactly. So we've been going at this for a little bit over an hour. I mean, I obviously talk too much. I know that people are going to comment, but I mean, what else? I mean, what else are you looking at? Tankers, uranium. are you are you sniffing around coal? I mean, I've got, I'll say I got Mongolia mining. I've had it for a while. That thing was cash flowing like crazy. It just came out with annual earnings and stuff, but it is Mongolia, so I don't recommend it. But coal, especially met coal, is really intriguing me because it's like, it's kind of like, chlorine is something that enables civilization because of clean water. It's the same thing with met coal. It enables steel. That's a civilizational requirement, even in video games when you're building like civilizations. But
Yeah.
I mean, do you have any interest in that, or you think you got your plate full right now with what's going on with uranium and
Um,
tankers?
yeah, I'm very interested in it because the way I view it is you've either got cyclicality or you've got stuff that you can ride for a far longer time. And I reckon you're going to be able to ride coal for a, far longer than the shipping and the uranium. So the way I view it, I haven't got almost any exposure to coal now. I think I've got a tiny bit of Peabody, but generally I'd see as hopefully make the money out of shipping and uranium, and then look at to deploy it into coal because I see coal's going to have a lot of sort of tailwinds that'll help it outperform for a long time, as it's not going anywhere. Anyone that sort of says coal's going to disappear off the sort of energy scene hasn't done their research, don't understand that there really is no alternatives to it in developing and emerging countries. There's no way around that when you're talking sort of for making steel, making like even yeah, I'm 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 equally bullish almost thermal as I am met coal. Like I just think there's going to be a huge demand for it moving forward, and at the same time we're seeing all these emission sort of ESG carry on is just going to capital starve it, which means you're gonna get a similar sort of setup to the tobacco companies where everyone thought they were dead because they were being capital starved, but still great business. It's still got a lot of demand throughout the world, so they're just gonna pay down their debt and pay fat dividends and buy back their stock, and it's going to be a great trade for a long time. And you just can't tell anyone that you've got a portfolio full of coal. It'll just be your little secret, and just do well over the next sort of 20 years. So no, that's kind of the way I view coal. It's another thing I'm going to rebalance into and look to hold for a longer time because it's not going anywhere unless we get some pretty significant tech breakthroughs. But it also comes back to this first level thinking. Like I see a lot of people talk about hydrogen, like you can possibly replace a lot of creating steel with hydrogen. Well, like how's that hydrogen made? Like tell me where that comes from. And
Yeah, exactly.
kind of gets stunned look on people's faces when they work out that that's just split off natural gas and creates CO2. So your your way to reduce emissions is even creating just as much emissions if you just go down the supply chain. And yeah, there's very few people that have sort of gone right down the supply chain and worked out what makes sense. And I think it's a lot of the stuff is just going to be just general fossil fuels are going to be around a lot longer than all the sort of renewable and EV projections would have you believe.
Yeah, it's interesting. I always look forward every year to the BP statistical review, which I don't know if you've ever looked at it, but they put it out for free every year, and I refer to it in a tweet or something like that. And it's just, I mean, they do projections out, obviously, and you can just see the same thing. I mean, you're just not. It's like I try to tell people, it's like because I'm right now I'm building a renewable plant. It's a wind farm. It's like all these tower sections, the steel, the rebar that goes in the ground, the cement. It's like, how is cement made? I mean, people just don't even know these things. It's made in a kiln
Yeah.
and it's
Yeah.
fired by natural gas. I mean, come on. I mean, these people, but I think that's the advantage, right? That's the advantage we have, or people that are of our persuasion that kind of think these things through. You have that advantage because you're seeing beyond the first order thinking. And it's just like I said, sitting down with people at a poker table that don't know how to play the game properly, don't know positioning, just don't know. So I don't really have any sympathy. If you want to step into the arena, you should be prepared. But I don't really argue with people anymore. I guess. Yeah.
I was gonna say it's also quite painful at times, because I think last time we were talking, to use the analogy of, it's like we got to the supermarket earlier. We can see everyone running down the street, so we think we'll duck into the supermarket, look around, and think what's going to be required, like what's going to be in demand. So we grab the tuna and the beans, and then the crowd rushes in and grabs the toilet paper. And the it's it's you can be thinking the second order effect, and yet everyone's so busy in the first order that you're actually very wrong, because what you bought keeps getting cheaper, until obviously later it's just having the patience and the conviction that they're not going to be able to eat their toilet paper, and eventually you're going to be able to charge a premium for your tuna and your beans.
Yeah, that's right. I guess part of the thing I'm thinking about too is I think if this goes on, I don't think we're going to have a V-shaped recovery. Like I said, I'm not an economist. I do think about these things. You have to think about it if you're in the markets. But just because, I believed that we were living in the biggest financial bubble of all time across a lot of asset classes, except for a lot of resources. But I was looking for a pin to pop, and this thing popped it. So I think this is disappointment and expectation that people, or they're going to have disappointment, because the expectation is, I hear everybody talking about, well, V-shaped recovery will come right out of this. I don't think that's going to be the case. And I think that, like I said, I said on a couple of the videos, I own a piece of some smaller businesses, and they're not coming back. The general partner already told us that the one business is basically, there's nothing we can do. It's out of business. It's not going to come back. So I had 10 employees. And I'm looking at this and I'm thinking to myself, what is going to happen? I think we're going to see a lot of this nonsense. If you have blue hair and metal in your face and you're protesting with your bra off, that kind of shit's going to go away. People are going to be tired of that. They're not going to want to listen to Greta and her bullshit. People are going to be pissed off, because now, I'm looking at guys I work with. I work with a lot of guys in their 20s. They were just coming of age during 2008. I've seen now 1, 2, 3 busts, to tech bubble, housing bubble, and now this. And, I'm wise to it, but look at the average person now. A lot of people's plans, dreams, views of how their future is going to be are going to get dashed. And that's got to have social, economic, and political consequences. Maybe we do come out of this and it all works out fine and we go back to the way it was. I don't think that's going to be the case. I look around, like in the company that I work for right now, my day job, you could get rid of half the people. Everybody's sequestered. They're not in the office. It's just us in the field working, and I don't need any of those people. They're like useless. And I think that's a big part that's going to become obvious, I think. And then I think that a lot of things are going to change, because I think hard times force people to get serious. I don't think we're serious people in the West. We haven't been for a while. And I'm just wondering, maybe I'm getting a little bit too philosophical for a, investment show or whatever, but I think I've been thinking about that. And I think it has to have some, I don't know if you can, it's actionable. It's not really something that's investable, but do you consider these things? Is it coming into your thinking? What are you seeing? Because that's the same thing, like we're talking about renewables and the environment. I think people are going to be concerned about eating and heating their house in the winter more such than what the CO2 level, ppm level is in the atmosphere.
Yeah, well, the way I always try and boil it down to something that I can trade. And so the way I see it is, we had enough global unrest and protest before this all kicked off. And so this is just 10x that. So as soon as this social distancing is over, there's going to be pretty big issues globally with people just being unhappy, more protests, and I think you're going to see more of this, essentially trying to print and provide sort of socialist programs to calm the crowds. It's all politicians do, and there's going to be no one will stand in their way. Before that, there was enough. Even Germany has sort of said that it's going to throw its rules to the wind and sort of look to run deficits and whatnot. Whereas before it was very conservative. So you're going to see everyone start to sort of throw caution to the wind and follow the more Japanese model of buying everything and printing, and that all just leads down this inflation road. And that's before you just take in the dynamic of what we've talked about with oil. Like there's no way oil doesn't rally off the back of this and cause sort of cost push inflation. If you want to look at a good sort of parallel, it was probably the 70s, and that was just a absolute rip roaring rally there. And yeah, it's going to cause more unrest, because then I don't see this sort of inequality resolving itself anytime soon. If anything, we've seen more of the money go in the wrong pockets already. Like it's such a nuanced thing to try and save companies, even when, like in America, you've got a lot of them are sort of being leveraged up by private equity. So you're essentially bailing out billionaires again, and that sort of stuff gets focused on, so people get even more riled up by it. And yeah, whatever, they only get their $1,200 paycheck. I've seen it here just in Bali. Like people, like there's hand to mouth, and then there's like emerging country or developing country hand to mouth, in which they're literally earning the money during the day to feed themselves that day. And so you forget, like I always like that stat that 60% of Americans, I think it was, couldn't come up with $600 in emergency. And that's America, which is a lot better off than a lot of the emerging countries. So they just simply can't stand this sort of this shutdown and being cut off from income. So it's going to cause a lot more unrest, which I just think is all going to cause that much more of a feedback loop into inflation.
Yeah, I couldn't agree more. So we're coming up on an hour and a half. You got any closing thoughts or anything that we didn't cover that came to mind, or I cut you off, or anything like that? Anything you want to say before we shut it down?
No, not particularly. I just come back to that. One of my biggest lessons lately is just to have conviction what you enter. Don't ever enter something on someone else's terms, because you're unlikely to hold it through volatility. And also be equally suspicious of something that doesn't have volatility, because it's often, as we're seeing, hidden in other areas. Like if something just nicely goes up smoothly, then generally you're going to be forced to stomach all the volatility at a later date. It's probably not going to survive it in some of these products, like the what am I thinking of, like the IXV, some of those like short volatility are just the classic Taleb, no volatility, like nice smooth curve up, like the sort of the fattening of the turkeys before Christmas, and then Christmas comes and you get slaughtered. So you always want to be on the other side of that, and that you've got asymmetry. You've spread your risk across quite a few positions, that you're not gonna take a sort of a fatal blow if you get one wiped out. And you just got to sit at the table and wait for your turn to get lucky.
Yep, well said. Appreciate it. So that's kind of getting to the end here. I think your internet presence that I know is just pretty much Twitter. If people want to follow you, you're a pretty good feed to follow. I kind of really digs a lot of the stuff that you say. You have some good references to some quotes and stuff, and then some of the tweet storms that you've done are pretty darn good. So if you want to let people know where they can follow you if they're interested on Twitter.
Yeah, it's just Twitter really. Everything else I do is with Brad is pretty much behind the paywall. So with Twitter, it's just Trader Ferg on Twitter, and that's where I pretty much, it's my like trading diary and all my thoughts. I'm just constantly sort of chatting to people on there and just dropping any ideas I have, or I'm pretty open talking about all my trades. Like I'm not don't sort of like trading as my income, so I haven't got anything to sell or anything. So I'm just open with what I do and how I'm looking to make money in the markets.
All right, brother. Well, I appreciate it. Like I said, it's been a good discussion, and definitely appreciate you taking the time and coming on. And like I said, I encourage people to follow you, and I think your statement around having conviction and knowing what you own and why you own it, that's something I've been harping on too. Most people don't follow that, I think, so definitely appreciate it.
Fantastic. Well, thank you very much for having me, John.
All right,
Really
brother, have a
good.
good one. I know you're living in paradise down there, so I won't keep you from it. I don't know if the surf's up today or not, but I'm sure.
We're not allowed on the beach, which is very unfortunate. Yeah, no, we're still in full lockdown here.
So how
Yeah,
do they enforce it there? Do they like go around and cane people? I see they do that in India, but they're chasing people around the beach here too. A guy, I put it up on Twitter. I thought it was funny. Just as a side note, this guy was jogging down the beach by himself. Cops came out on the beach. They had their shoes on or whatever, their little uniforms. They started running after the guy. The guy just speeded up and left him in the dust. So I don't know. How do they do it over in Bali? Do they come out and cane you, or will they cite you, or how does it work?
Yeah, so here they blockade the beaches. So there's most of the beaches you can't get to without going down somewhat of a little path or street, and then they've got called like the local banja. It's essentially like a cross between the council and mafia, I guess. And they're everywhere. So yeah, you don't mess with them. And yeah, they just block it all off, and pretty much nothing's open now apart from supermarkets and pharmacies. So yeah, we've just been a lot of villa time, a lot of time on just on the computer, and that's about it really. Yeah, so we did make the mistake of getting two sort of young puppies that we rescued, and we thought, oh well, it'll get us out because we'll run them on the beach every day, and the day we got them, they closed the beach that day. So yeah, we've got these two puppies just going nuts around the house, and we can't go anywhere really because there's no footpaths in Bali as well. So we've had to
Oh
find
wow.
a dirt road or two that we can run them. But yeah, other than that, yeah, looking forward to it ending, to be honest. But it's been good time to get some work done.
Yeah. All right, brother. Appreciate it. I'll get this up as soon as I can, but definitely appreciate your time.
Thank you.
All right. Have a good one. Thanks.
You too, John. Okay. So
Bye.